back, everyone. In this lesson, we are going to be looking at trends. Before we start, I want to give you some context on an absolutely crucial point. In technical analysis, every pattern, indicator, theory, and technique has one single end objective: identifying the trend. Technical traders do this with a view of participating in the trend.
Of course, from what we've learned so far, I can see how important it is to be able to identify trends.
Good! We're going to cover a lot in this course, and I'll make sure that whenever I introduce something new, I'll link it back to the trend so you can see why we are talking about it.
Sounds good. Let's get started.
Okay, so if I were to ask you what a trend is, what would your reply be?
I'd say that a trend is when a price goes up or down.
That's a good start. In the markets, a trend is a general direction in which a security price is moving.
Got it. That makes sense.
Good. So because time is continuous, there are three types of broad trend: up, down, and sideways.
I've heard of the first two, but a sideways trend, is that as obvious as it sounds?
Well, let's start by looking at the first two. An uptrend describes the price movement when the overall direction of the price is upward. A formal uptrend is when each successive high and low is higher than the ones found earlier in the trend.
Yes, I remember this from the Beginning to Trade course.
Good. For those who didn't take that course, an uptrending market is called a bullish market.
Great. Okay, so what about downtrends?
Well, do you remember about downtrends from the Beginning to Trade course?
Well, a downtrend is when the price moves downwards, isn't it?
Yes, that's basically what it is. A downtrend describes the price movement of a financial asset when the overall direction is downward. A formal downtrend occurs when each successive high and low is lower than the ones found earlier in the trend.
And a downtrending market is called a bearish market?
That's right.
Okay, so what's a sideways trend? We haven't covered this before, have we?
Sideways trends are when markets are in equilibrium and there is neither a bullish or bearish trend. It's simply when the price moves sideways. Remember, a market must always be either bullish, bearish, or in equilibrium and moving sideways. Okay guys, let's put your knowledge to the test. Take a look at this chart. Tell me, what do you see?
I see uptrending. The price is getting higher and higher.
Good. How about now?
Well, I can see that the time frame has changed, but now it looks like the market is downtrending.
Well done. It is.
I don't understand. The market is the same, the sterling dollar currency pair. All you've changed is the time frame, yet the trends have completely changed.
That's the point right there. Sometimes it pays to view the same market in a different time frame to get a wider view. The weekly time frame suggests a general downward pressure on the market, but the daily shows an upward trend. We'll show you the methods for identifying and confirming trends. In the method of trading I'm introducing you to, it's crucial to know what the longer term trend is in a market. These trends are classified as secular for long time frames, primary for medium time frames, and secondary for short time frames.
And does this apply even if you're a day trader trading short-term trends?
Yes, it does. And this point is crucial as it normally forms a major part of a trading plan.
Okay, got it. Thanks for explaining.
Okay, so now that I know what the 3 different types of trends are, how do I know what's going on in the markets when they form?
Well, we know that a chart provides a picture of historic prices. Market participants in a free market are in a consistent arm wrestle around price, and we broadly group these participants as bulls or bears.
Yes, we covered bulls and bears before.
But there are also undecided parties, those who are uncertain.
Okay, we haven't come across these before.
In reality, each participant will view the market differently and their views will change over time. All these views are expressed through the position and trading action that are taken. All this comes together and the end result is one single number, the price.
Right, I see. So through time, a trader's opinion on the market may change. Therefore, so will their positions, which in turn affects how trends are formed?
In a word, yes. When prices trend up, the phrase that's normally used is the bulls are in control. But what is actually happening? Let's try to describe simplistically what's going on. Remember, this is generally across market participants as a whole. Those that own an asset are gradually demanding more and more in order to sell it, which means that their view of an acceptable price to sell it is improving with time.
Okay, I think I'm with you.
But this doesn't last forever. To sell it means they no longer hold the perception that the price will continue to rise.
Yes.
If they did, they wouldn't have sold. These participants have now either become uncertain or bearish.
I see. I'm starting to get it now.
Good. So the participants they sell to are happy to buy because they perceive that the price will continue to rise. They are buying now instead of before because their previously held view that the price will not go up has changed. They have become bullish. When these participants' views change, they will sell.
Right, I see now how there can be undecided parties.
Hopefully that makes things a bit clearer. For a price to continue trending upwards, there needs to be enough buyers willing to pay an ever-increasing price. Maybe our original participants decide that they were wrong and buy back in. Maybe the undecided participants get the confirmation they wanted and buy in. Maybe our current owners increase their convictions and buy more.
Of course, but why do they change their minds?
Remember, as technical traders, we aren't concerned with why views change. We just acknowledge the fact that they do. Trends don't last forever. At some point, the general perception around future prices rising will change enough so that the collective balance of the bulls being dominant stops. This is called a trend reversal, and it happens when there are not enough participants with the view that a price will rise. There aren't enough participants willing to pay an ever-increasing price, so those looking to sell can no longer demand it. If the uptrend switches sideways, the two forces are in equilibrium.
And if the price starts downward trending, the bears are in control?
Exactly. When we conduct technical analysis, we are looking at where this balance of power changed in the past, using the tools we are going to show you in this course. Try to predict where it has potential to move to in the future.
Got it. Thanks. That's a really good explanation.